Remember, everyone was talking about risks of deflation, actually. And what we are actually facing is surging inflation to the point that people are talking of stagflation. They are certainly not talking about deflation. So I would say that this is a non-trivial global risk. It will put pressure potentially even on food prices. And I think it is something that central banks, especially in emerging markets, can simply not ignore. Our banks, especially public sector banks, own very large chunks of government bonds.
Yes.
Credit growth has not kept pace with deposit growth. And that most likely means that an interest rate correction would have some bearing on their ability to buy more bonds. There could be mark-to-market losses. Historically, that has always led to some forbearance, but it's forbearance. It's not. You can't just hide economic losses away for forever. I think bottom line is that inflation is higher, much higher than what anyone thought it might be at this time post-pandemic. Remember, everyone was talking about risks of deflation, actually. And what we are actually facing is surging inflation to the point that people are talking of stagflation. They are certainly not talking about deflation. So I would say that this is a non-trivial global risk. It will put pressure potentially even on food prices. And I think it is something that central banks, especially in emerging markets, can simply not ignore. Central banks typically have primacy of their inflation mandate. And because central bank policy operates with lags, I think these inflation headwinds to growth, these inflation headwinds on the external sector, these inflation headwinds which will play out potentially as a faster than expected normalization and tightening by the Federal Reserve. I think these are risks that cannot be taken very lightly at the present. I think in the case of India, my experience as a deputy governor was that one has to pay attention to two or three sources of vulnerability in the debt markets. First is that there's a tendency in the non-bank financial sector to shorten the duration of its bonds as interest rate increases become imminent, because they don't want to lock in a higher but steadier rate. They want to take the risk of a short rate, which is lower because of a rising term structure. And then what that creates is it creates a rollover risk for this non-bank financial companies. So I would especially look out for liquid debt mutual funds, whether they are funding short-term debt for non-bank finance companies. Second, I read through some work put out by Mr. Harshvardhan and others that there is also seemingly a rise in floating rate fixed income instruments being issued.
Yes.
That is just another variant of wanting to take on a lower interest rate borrowing cost in the short run at the risk of facing a higher interest rate risk down the line. So these are all signs of interest rate bets being taken on. Third issue that always comes up in India is that our banks, especially public sector banks, own very large chunks of government bonds.
Yes.
Credit growth has not kept pace with deposit growth. And that most likely means that an interest rate correction would have some bearing on their ability to buy more bonds. There could be mark-to-market losses. Historically, that has always led to some forbearance, but it's forbearance. It's not. You can't just hide economic losses away for forever. So I think these are various channels through which interest rate hikes permeate into the economy. Our large corporates have definitely benefited from higher inflation and lower borrowing costs. They have been the concentrated gains in the stock market. and there could be corrections there as well. Uh, Globally, even sovereigns have started borrowing short term to bet
Yeah.
on lower interest rates being sort of engineered by the central banks. And there could be some fallouts there as well. So I think there are multiple points of stress and froth in the fixed income markets. If I were a central banker, I would do serious stress tests right now to see how an interest rate hike would play out in banks, in non-banks, in stock market corrections for large companies which have been the beneficiaries of high inflation and low interest rates. How would
Yeah.
the sovereign debt rollover programs play out with higher interest rates? And if these risks don't look very good, I think it would mean that you want to embark on a smoother interest rate hike trajectory rather than making it very backloaded and then doing too much of it in all of a sudden. See, certainly our debt to GDP ratios have risen because of the pandemic and the GDP having come down. But, in some sense, the government expenditure needs not having come down. Because the formal sector has been such a big beneficiary of the pandemic and the pandemic stimulus, it has raised tax revenues for the government. But really, for the debt to GDP to come down to more sustainable levels in the long run and take us away from the fragile 90% levels, I think we just need higher growth on a sustained basis. And I would say that the focus has to be on the sustained basis and not to get too greedy in the short run. This requires a focus on structural reforms. I would say that has to be on infrastructure, health, and education. And in infrastructure, I would include sort of the digital economy and access to bandwidth, the quality of the bandwidth, quality of the tech services that are being provided all over the country, so that again, it doesn't become just a stock market and a formal sector benefit, but we want to spread this benefit across. I think I would stress the risk that I mentioned, which is that if interest rates have to be raised too soon and very rapidly because you have left checking inflation risks as a backloaded adjustment, I think one runs the risk of a disorderly adjustment in the government borrowing costs. And so much to the contrary of what everyone says, I would say that uh, 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 a steady but a smooth adjustment of interest rates to the inflation risks may be to the benefit in the long run for the government borrowing program, because we have seen situations like the taper tantrum where one had to use interest rate hikes as an interest rate defense because too much had to be done in too short a period of time. You don't want to take those kinds of risks on hand. There is time. I think the growth rebound in India has been good. It has been strong. I think the government has put in place strong reforms, both on structural side as well as on fiscal funding side through privatization. Push on that, push on the privatization so that the reliance on the bond markets is reduced, and use that space to actually have a smoother adjustment of interest rates to deal with the inflation risks.